All right, my friends, we're now going to pick up with a really important area on your CPA exam, and that is revenue recognition. One of the hottest topics in all of accounting, whether it's the FASB, the SEC, the PCAOB, the auditing standards at the AICPA, they all focus in on this area. So therefore, this is an area we can expect to be heavily hit on your exam. So what we're going to learn is what I've created, this little 5-step approach to remember each of the requirements in the steps to recognize revenue. So let's take a look at some of the items. Now, when do you recognize revenue? Well, the rules of conservatism say, thou shalt not recognize revenue until the earnings process is virtually completed, right? Very simple rule. Well, we're going to show you some of the nooks and crannies that are essential in understanding this. So you satisfy what we'll call a performance obligation when your goods have been delivered or your services have been rendered to the client. And of course, revenue should be recognized that reflects the expected consideration that you would be entitled to, which is a little different than the rules 5 or 10 years ago, where it was under the rule of conservatism, it was the least amount that you are legally entitled to. Now it's the amount you expect to be entitled to. That's one of the fundamental answers that we're going to be looking for. Now, there are other standards that deal with other items, such as, and that means that you're not dealing with topic 606. Instead, you're going to be looking at other ones like leases. That happens to be topic 842. Insurance, non-warranty guarantees, and of course, financial instruments, which are typically marked to market. You write them up as they go up in value in the market. You write them down as they go down in the market. And that happens to be in your 300s, like 320, investment in a debt instrument, 321, investment in stock of another company. You also have 323, using the equity method when you exercise significant influence over another company. And of course, 325 is other. So financial instruments is in the 300s. That's not what we'll be looking at. We're looking at 606, which is the big, giant monster area. Now, we have a little memory tool that I'd like to use with you. I've referred to it as I am a star when I recognize revenue, right? You always want to take credit for all the revenue that comes in. And by the way, that's in the real world. And of course, it's in the journal entry. You're going to debit cash or debit a receivable, and you're going to credit the revenue, right? So you always take credit for gains and for revenue. Those are good things. Always take credit for them. So I stands for identify the contract. You want to make sure that you have an enforceable right. Then you separate the stuff you're going to do. We call the stuff you're going to do separate performance obligations. For those of you who have been in the business world for years and now you're just jumping into taking the exam, this is what we used to call multiple element arrangements. Again, you don't have to worry about that if you're brand new to our profession, but elders like myself, we know it as old terminology, but now it's called separate performance obligations. Then we determine the transaction price, the amount you expect to be entitled to. How much do you think you're going to earn? Then step 4 is you allocate. You allocate that price, the amount you expect to get, and you divide it over each of the performance obligations that you are going to be required to do. And then you recognize revenue as each separate performance obligation is being done. You recognize revenue either point in time, in other words, as it's done, or you can recognize it over time. We're going to learn point in time. You finished a job, you handed them the bill, you're done. Or maybe it's a subscription, and now you have to give them a magazine every single month, or you have to give them an email blast every single day. So you're going to recognize revenue over time. So those are the fundamentals of I am a star. Now, let's go to the first letter, I. You have to identify the contract with your customer. This is when you have you and them, and you have an enforceable right or obligation. And the reason we want to make sure it's enforceable is because often you have somebody will come by and they decide to shovel your sidewalk from the snow, and then they ring the doorbell and say, you owe me $5. I never agreed to that, right? So that would not count. You have to have an enforceable agreement, which could be verbal. That could be two people shaking hands and just understanding. It could be written, which is, of course, the more prudent way to do it, so that, one, it reduces any misunderstanding, And if there is an issue, you've got an enforceable contract. Or it could be implied based on the conduct of the parties. Now, a customer is a party that has contracted with us to obtain our goods or services. Now, the criteria for identifying the contract, it has to meet all of the following. One, all the parties at the appropriate level have approved the contract, which normally means they've signed it if it was written, or they orally agreed to it if there was oral. Rights of each party have been identified, so we know what we have to deliver, when we have to deliver it, and of course, payment terms have been identified. Do they have to give us a retainer up front? Do they have to make a progress billing? When do they owe us the final balance? And it has commercial substance, which means that cash flows, risks, and timing of it are expected to result. And notice, finally, the probability the entity will collect. There is that old-fashioned, that rule of conservatism, right? You want to make sure that you have an enforceable contract and that you will collect. You'll notice the criteria assessment also considers that you performed it at contract inception. So all of this, do you have an enforceable contract, is when you start. You don't do it after you've done the work and say, gee, can I possibly collect on this? I wonder what the price should be now. If the criteria are not all met, then you have to go back and regularly assess as time goes along. Now, if the criteria are not met, but consideration has been paid, in other words, they paid, but you didn't have an enforceable contract, then we're going to go to the cash basis. And let me give you an example. Let's say I'm doing a continuing professional education course for one of our CPE clients, and we do multiple amounts. I do about 60 different companies on a regular basis annually. Well, one of them has an annual contract with us, but now it's January, and they never signed the contract for the current year. I call them up the day before the presentation is to be made, and I say, hey, I haven't gotten the signed contract. And somebody says, oh, yeah, you're right. Our boss, well, they're on vacation right now, but they love you. They definitely want you. So, yeah, they're going to sign it. Just come on in and don't worry about it. We'll sign the contract in the next week or so when they come back. So in good faith, I go in and I do the presentation. I don't have an enforceable contract. They could walk away and say, well, it was nice that you came in, but we don't have an agreement. So under those circumstances, I haven't met the I of I am a star. Now I have to wait. I either wait for them to sign the contract, or more likely on a CPA exam question, they actually paid the invoice. If they paid the invoice, so I received the money and I fulfilled my obligations, I don't have anything else I have to do, then and only then can I recognize revenue under the circumstances of not having had a contract. Notice, if that's not the case, I'm on the cash basis. So I would receive the money, but if I still have work to do, I would credit unearned revenue. Well, combining contracts, here's where it happens in the real world. A company is going to do two things. They're going to develop software, and they're going to build the hardware, they're going to install it, and then they're going to train the customer on it. The biggest and most important part of the job is developing the software. And they include, you got to pay us for that part of the job, which is the lion's share of the money. But because this is all integrated and it really represents one giant package that we're delivering, let's say we can't break it up into separate and bite-sized pieces. Well, then, even though you got the money for the work you have done, if you can't break it up into bite-sized, separate performance obligations, then you would debit cash and credit a liability, unearned revenue, deferring it. No management team likes that. They want to recognize revenue as quickly as possible and look good to the shareholders. So it's important. Well, sometimes the lawyers try to get creative with us. What they'll do is they'll say, aha, let's create one contract for developing the software, a separate contract for building the hardware in their office, a third contract for installing everything, and a fourth contract for training them. It'll still be the overall same price. We'll explain that to them. I think we've beaten the system and we can recognize revenue now as each separate contract is done. Well, we have another rule that says, nice try, lawyers, but it won't work. It's called substance over form. The substance of the transaction was we had to do all of those elements in order to complete the job. So therefore, even though they were separate legal contracts, legally you can do that. it would still be that we would have to mesh them together and treat them as one giant contract. So in that case, even though you broke it up into two separate contracts, sorry, we're going to combine them for an accounting point of view and treat them as one giant contract. Well, contract modifications, especially in the construction area, this is so common. You agree with a construction company to build you a new home. Well, you add something. Is it just you want to change the high quality of the wood that you're using in the rooms? Or is it you want them to build you a swimming pool? So is this a new contract, an added on that they're just going to add? Or is this a modification of the current one? Well, it's a new contract if the scope increases, like, hey, can you build me a pool in the backyard? My bonus this year was even better. And the price increases. It's a modification if really there is no additional change in the timing. Maybe it's just the quality of the woodwork that you're going to use internally to frame the house. That would probably be a modification, not a new contract. Well, let's move on from the identify the contract, make sure it's enforceable. Let's now go to the S of STAR. We want to separate the stuff we're going to do. We call the stuff we're going to do the performance obligation. So here, the performance of an obligation is a promise to transfer some of the goods or some of the services to the customer. And it can be either an individual good or service or a bundle of them. It could be a series of items like magazines. Notice, if the promise to transfer the good or service is not distinct, then they have to be combined and they're all treated as one contract. By the way, one performance obligation, management doesn't like that, because then even though they've delivered one item and maybe they even got paid, they can't debit cash and credit revenue. They debit cash and credit a liability. They have to wait for the rest of the stuff to get done. That's the old rule of conservatism. Thou shalt not recognize any revenue until the earnings process is complete. Now, in order to be distinct, which is, of course, what you want to do, you want to be able to break it up into these bite-sized pieces and then recognize revenue as each separate, distinct, bite-sized piece. Each separate performance obligation is completed. One, it has to be separately identifiable, and it has to be that the customer could benefit from that item independent without anything else. Even though you're going to deliver other items, they could deal with this all on their own without anything else. Well, what about separately identifiable? Well, let me give you an idea of some of the issues that can occur. An entity does not integrate the goods or services with other goods or services. And let me give you an example where that would not be the case. I've gone to an engineering company and I said, design me a brand new house and then build it. Well, they're designing the house, which technically you would say that's okay, but then they're going to build it. Those are so intertwined, they're integrated. So hence, in that case, you can't separate them. Even though once the blueprint is done and you approve it, you're going to pay them some of the money. They'll debit cash and credit a liability. They haven't earned everything yet. And number two, or the goods or services are not customized or modified. Think of a software company where they're going to take their basic software and they're going to adjust it and modify it so it meets your specifications, and then they're going to ultimately input it and integrate it with your other systems. Well, that's modified and customized. So you can't separate the fact that you developed it, then you modified it, and then you installed it. That's all modified and customized, so you can't break that up either. You'll notice a good or service does not depend on or related to other goods or services in the item. And that's all part of the same process. If those happen, you're going to have a problem. So if it's not dependent, if it was not customized, if it's not integrated, then you can separate them. Now, not separately identifiable, some of the factors would be they're highly interrelated, they're interdependent, or the entity provides a significant service of integration with them. Let me give you two examples here. All right, Tanner is building a multi-unit residential complex. So there's multiple units. A prospective customer comes in and says, oh, I love that corner unit. It has the best view of the lake. So they want that one. and they say, we want you to do the piping, we want the wiring, we need Wi-Fi here, we need Cablevision hookups over there, we want you to install certain equipment and then do the beautiful woodwork finishing. Well, you would say that building the unit and then doing those things could be interdependent, and they are. So therefore, even though you might be able to argue, well, these are separate functions and we designed separate contracts, the bottom line, they cannot be identified separately from an accounting point of view. This is one giant contract for one giant delivery to the customer. And even though they might give you security deposits, it's a liability, not revenue, that's being credited until the job is done. The second one, a software developer is developing software that they're going to transfer a license, they're going to perform installation, and the software will be updated as needed, and technical support will be provided for 5 years. The entity determines that each good or service is separately identifiable because the installation does not modify the software, and the software is functional without any updates. Therefore, in this case, because they are all separate, right? It's kind of like Microsoft giving you the Office. Microsoft Office, you load it, you may be paying them to say, hey, can we pay for you to do something else? But Microsoft Office works all on its own. You don't need to modify it. The service can be done at a later point. So now, in this case, we do have separate performance obligations. The software license, that's one, and you can recognize its revenue when that's granted. The installation, you can recognize that revenue when you perform that service. Any software updates can be recognized. Now, if it's guaranteed, it may be over a point in time, or if it's based on certain times of the year, then it would be at those moments. And then technical support, that would be a 5-year contract. Whatever revenue is allocated to that portion would be recognized over time, typically on a straight line basis. All right, that concludes our discussion to introduce you to I Am a Star. All right, my friends, we're now going to pick up with the next area of I Am a Star. Now, we have the I, identify the contract, make sure it's enforceable. It could be written, it could be oral, it could be implied. We then separated the stuff we're going to do, if we can. If we can't, we have to lump it all together from an accounting point of view. Legally, you might be able to separate it, but from an accounting point of view, substance over form. Now we're going to the transaction price. It's the amount we expect to be entitled to. And this is basically a reasonable estimate. Maybe there's going to be bonuses for completing it early or penalties for completing it late, right? Those could be some of them. There may be a clause that says if you can find anybody who would sell this item to you cheaper, we'll match it, right? There could be any of those types of items. So it's all based on the factors. Factors like, number one, variable consideration. Maybe it's how often they're going to use it or how much they're going to ask for. It could be the financing. Are we going to allow them to pay it over a long period of time? And then we're going to look at any non-cash consideration. Maybe it's not just they're going to pay us in cash, but they're also going to give us a piece of land, or they're going to give us some stock of their company as part of the consideration for what we're giving them. And then any other consideration that's payable to that customer. Well, let's look at each one of those factors individually. First is variable consideration. In this case, it's the amount, and it's estimated by a range of possible amounts, right? What's the high? What's the low? You want to look for the most likely. That's going to be your expected value. But one of the constraints you're going to have in determining the amount that you expect to be entitled to is the rule of conservatism, right? You never want to be estimating too high where you could wind up having to reverse the revenue. Oh, we guessed too high. We're not going to make that much. Sorry, we have to reverse revenue at some future point in time. We don't want to ever see that happen. That's a big constraint. Then we look at financing. You know, especially if you say to somebody, hey, you can buy our product and you don't have to pay us for 3 or 4 years, and there's no interest, right? You're trying to tell them, listen, buy it now, pay later, right? A very attractive marketing tool. Well, in that case, you have to discount because even though you claim that there's no interest, Essentially, you're building in the interest to the purchase price, one way or the other. So you have to take the amount, and when they're going to pay you, bring it back to a present value. You bring it back to the discounted net present value. And then, as they make payments, some of it's the principal, and some of it's the interest income. So typically what we say under the rules of accounting for revenue recognition is if all the payments will be made within 1 year, then you don't have to worry about discounting. But if it extends beyond a year, then you have to discount the payment terms. So what happens if there's non-cash? An example, what happens if they say, hey, you can pay us and we'll accept some cash, we'll accept that piece of land and with the building on it and some common stock of your company. Well, under the normal rules, consideration would be the fair value of the building and the fair value of the common stock at that time. Well, how about consideration payable to the customer? That would be kind of like, well, you bought it from us, you paid us quickly, we're going to give you some money back. Well, if you're giving them some money back, the consideration you're going to give back to them is a reduction of the purchase price. Unless you're giving it back because they're going to give you something. So they're buying something from me, and I've agreed to charge them. But also, to ingratiate myself, I'm going to buy one of their products, and they've agreed to sell it to me. Well, then the amount I'm paying them is for that product. But if there's no product being received, essentially I'm just giving them a rebate because they were a good customer and they paid on time. So let's take a look at an example. Notice in this case, January 1 of year 5, this company sold furniture to a customer for a $4,000 fee with a 3-year interest-free line of credit. No interest, no payment, no interest for 3 years. That's more than a year, isn't it? So therefore, the customer took delivery. The $4,000 is payable each year, or in this case, December 31st of year 7. So no payments in year 5, no year payment 6, only at the end of year 7. Are we going to have to discount this and treat some of the payment as interest? Absolutely. So when we use our discounted cash flow model, we find out the present value of that is $3,175. It's gone down by $825, which is now imputed to be interest over that same period. So in year 5, when they don't pay us, we accrue $254 of interest. That's an increase to the receivable and a credit to income. The next year, we then increase it by the outstanding balance and charge $274 as an increase to the receivable and a credit to interest income. And then the third year, we do a debit to the receivable for $296 and credit interest income for that same amount. Now, the receivable has gone from $3,175 all the way up to $4,000. If you add up those three numbers, that is the $825 of imputed interest. That's recognized as interest, not as sales revenue. Well, step 4, we allocated the transaction price to all of the items that we're doing. How do you allocate it? You allocate it based on the relative fair values of each item. So let's say you've got a whole bunch of consumer goods and you're selling all of them. And there's one basket bucket purchase. You then take that amount that you're expecting to collect and you allocate it to each of the items based on their proportional relative fair value. Now, you look at what their standalone selling price is, and then you allocate accordingly. If there were discounts, that's allocated proportional. If there's variable consideration, it may be allocated to the entire contract, or it may be to one element that ultimately they may buy 1, they may buy 2, they may need 3 over a stated period of time. So it could be to an individual performance obligation or one distinct good or service. Now, what about if the transaction price changes? Any change in the contract price should be allocated to each and every performance obligation based on the same basis that was used originally. Now, things change. Some things go up in value over time. Other items go down in value. Think of software. If I want to buy an iPhone, I can buy today's iPhone, let's say, for $800. That same iPhone, not the newest version, will go down and down and down in price over the next couple of years if they still have it in inventory. You would not make that adjustment. You would use the same basis used at inception. So here's an example of how the allocation would be done. Notice a software company enters into a $250,000 contract. Real easy. The amount we expect to be entitled to, $250,000. We have a contract, we've identified it. Now we look and we say, okay, we're going to do a lot of stuff. We're going to provide them with a software license, performance obligation number 1. We're going to perform installation, possibly performance obligation number 2, and we're going to provide technical support for 3 years. Now the entity sells the license, sells the installation, and sells the technical support separately. So it appears though each one of these could stand alone. You could buy one without buying the other. The license is usually sold for, all by itself, $160,000. Installation, if you just want to buy something from someone else and have them install it, $20,000. And technical support, if you want it, is $30,000. Well, if you add them up, that's $270,000. License $160,000, installation $20,000, technical support $90,000. That's $30,000 a year for 3 years. That's why I got $90,000. That's a total of $270,000. But we're only charging them $250,000, right? We're giving them a little bit of discount since they're using us for everything. And this contract was signed on March 1. So it's not a full year, which is a very common exam technique trick. They love to have it that, oh, they'll give you one of the answers, and one of the answers would be the full year. This is only 10 months, March through December. So right here, we have 3 distinct performance obligations because they can be separated. The software license, the installation, and the technical support. We notice the proportion of fair value for the software is 16/27. The fair value proportional for the installation is 20/270, and the technical support is 90/270. You'll notice those add up to that $270,000 we pointed. We use those percentages to allocate the contract price of $250,000. Notice the license and the delivery of it, and it's earned right away. That's going to be $148,148. The delivered and earned installation would be $18,519. And then finally, the technical support, that would be deferred and earned over 3 years each month. Well, notice your journal entry. They're going to pay us $250. The license revenue is upon delivery, $148,148. The service revenue when we install it is $18,519. Notice both of those are income now, point in time. And then the unearned revenue. The amount that we'll earn over 3 years is $83,333. If you add that up, that is your grand total of $250,000. Some of it now, some of it later. Well, what happens at the end of a particular month? So now, at the end of each month, times 10 months, you're going to notice unearned service revenue will be recognized. And remember, we started it in March. So therefore, we started it in March. We multiply it times, in this particular case, 10 months, and that would aggregate up to $23,148. It's $2,314 each month. So each month for the next 10 months, that would be the amount we take out of unearned, a liability being reduced, and we credit revenue. All right, that takes care of how we go through the I Am a Star. All right, my friends, we're now ready to complete the last step of I Am a Star. And this is the R of STAR, recognizing revenue, either point in time or over time. Right? This is when you satisfy the performance obligation, the stuff you're going to do. Now, stuff might be one item or a bunch of items. Now, control implies the ability to obtain the benefit, which is the customer has it. So you finished your job, you're leaving, you're waving goodbye, you've done your work. You now can recognize the revenue. As we said, it's either overtime, which would typically be for like a subscription service to a website or a magazine, or point in time when you've completed a job and you've handed it to them, or a department store. When you buy something, they hand it to you, they collect the money, revenue at that point in time. Now, satisfied over time. If you meet any one of these criteria, one, the entity's performance creates or enhances what the customer controls. So this would be the annual service contract, where I say that I am going to provide, malware to protect your system. And every week I'll install the newest and best version of it for the next 5 years. And you're going to pay me. Notice, you control your own system. All I'm doing is enhancing it on a periodic basis. So I will recognize that revenue over time. Or the customer simultaneously receives and consumes the goods, such as I have a website, maybe a blog, and I say if you pay X, you're entitled to view this every single day. So therefore, I allocate the revenue that you paid me over the time that you are able to access my website. And then, of course, the entity's performance does not create an asset with any alternative use. In other words, we're not making basic inventory. If all you're doing is making basic inventory, then you wait until that inventory is sold. This has to be for that customer with their access to it. Now, you'll notice you must be able to reasonably measure the progress if it's going to be over time. So it could be on an outputs or an inputs method, either one. Now, you'll notice outputs, think of a subscription service like a newspaper or a website. And every day you can look at your smartphone and you can get the information immediately. That would be outputs. I'm going to get it 365 days this year, so they can allocate 365 to each day or 1/12 to each month as it's being done. Examples would be products or delivered items over time, like a subscription, time elapsing where you've used it, milestones, or maybe an appraisal. Evaluation of improvements would be essential there. Notice when the outputs of progress are not available, you can't quite figure out where it is, then you should go to the inputs method. Now, inputs method classically might be a CPA firm. It's how many hours you've put into that audit engagement. That would be the classic example. So examples would be how much cost has been incurred in putting into this project, how much resources have been consumed and put into this project, labor hours expended on this project, or maybe time elapsed. Now, think of a health club in this case, where you pay a health club and you have the right to utilize it for the next year. Well, in that case, that would be inputs method, where every single day they've had one more chance to use it. Now, the disadvantages of the input, there may be no direct relationship. And therefore, if inputs are used evenly, like monthly, then straight line might be the best way to do it. So here's the example using that health club. A health club enters into a contract with the customer for 1 year. Unlimited health club access for $75 a month. Therefore, the health club determines that the customer simultaneously receives and consumes the benefit each month. You'll notice that means it's satisfied over time. You can't recognize all the revenue day one when they paid you because they have the right to use it for the next 12 months. So since this is time-based, you would recognize it straight line throughout the year. $75 each month for every month for a total of $900 over the course of the year. Well, notice, in the absence of a reliable information, if an entity expects to recover its costs, which in other words, if you're not, you'd book the loss right away. Rule of conservatism. But assuming that you anticipate making money and the customer's going to pay you, then revenue may be recognized to the extent that costs are recovered until that point when you've received all the money and then can book the income. Now, how about point in time? That's the other method, right? It's overtime or point in time. And in this case, a store. You go to a store and you buy a sweater, or maybe you go to the grocery store. Let me give you an example. I'm going to a grocery store and I grab a gallon of milk and I go up to the actual cashier. First of all, the customer has accepted the asset. I've taken it out of the refrigerated area. I brought it up and put it on the conveyor belt. Number two, the entity has the right to payment. They're going to take it and tell me how much it is and say, pay me. Number 3, the entity has transferred physical possession. They've put it in a bag and pushed it to the end once I've paid them. Number 4, now I have legal title because they give a receipt and put it in the bag. And then number 5, all risks and rewards are now mine. If I walk out of the grocery store and I trip and fall and that milk splatters all over the parking lot, they have no obligation to give me a new gallon of milk. They might, but that would only be because they're kind. They have no obligation. It's my risks and my rewards once I've walked out with that receipt. That's the classic rules for point in time. And let's give you an example. Tanner is building a multi-unit residence. The entity enters into a contract with a customer for a specific unit. They love that corner unit that overlooks the lake, as we said in a previous portion of our program. The customer pays a non-refundable security deposit. The customer agrees to make progress payments. If the customer fails to make the progress payment, the entity has the right to all of the money that has been paid. Note, the terms of the contract prevent the entity from directing the unit to anyone else. It is that customer's, and we're building it for them. That's satisfied over time because as we're building it, we have the right to collect. We are building it for them, and that would be just like percentage of completion contractors accounting. So the unit does not have an alternative use. We're building it to their specifications, and the customer is controlling it. We can't sell it to anyone else. Now let's turn those facts around just a little bit. How about Tanner is building a multi-unit residential complex? The entity enters into a contract with the customer for that specific unit again. However, in this case, the customer pays a deposit upon entering the contract that is refundable if the company fails to complete the unit. So if they don't complete the unit, I can get my money back. The remainder of the purchase price is due upon completion. If the customer defaults on the contract before it's completed, the entity only has the right to retain the deposit. That's it. So now let's determine whether this performance obligation is satisfied over time or point in time. And the answer is this obligation is satisfied at a point in time when the job is done. Notice they don't owe me anything until the job is done. If it's not basic inventory at this point in time, but the customer controls. So the entity does not have an enforceable right for payment until the job is done. So therefore, until the entire job is done, there's no money due, and therefore it's point in time. And that means revenue at the end of the contract and not during the contract from a financial point of view. Well, what do we talk about when you have a contract asset? Well, that's the right to receive consideration for things you've given, but you don't have the right to be paid right away. We're going to see an example in a minute where we're going to deliver 2 items, 2 cars, 2 plows, 2 excavation machines. And when we deliver the first, they don't have to pay us. They only have to pay us when we deliver the second one. They want the first one right away. They need it. So we say, fine, we'll get it to you right away. The second one, we're still constructing. It'll take a little bit more time. That's a contract asset. We haven't billed them yet. We don't have the right to receive the money yet. So it's a contract asset. It's not quite a receivable at this point in time. Note, if payment due date is conditional upon the passage of time, like you don't have to pay us for 30 days, then it is a receivable. You'll notice in this situation, an entity has either already received consideration from the customer. If that's the case, then you debit cash and you credit unearned revenue. That's why you could have a contract liability. You've gotten paid in advance, it's a retainer, and it's a liability. It's not income at this point. So let's illustrate this. In January, Anderson enters into a non-cancelable contract with Tanner for the sale of an excavator for $350,000. It will be delivered on April 1. The contract requires Tanner pay the $350,000 in advance. And Tanner makes the payment on March 1 before delivery has been done. Notice this, prepare the journal entry. The call of the question is, what's the journal entry? And the answer is, on the date that we sign this contract, you have a receivable And you'll notice it's a contract liability. We haven't earned the money, but they owe us the money on February 1. On March 1, they pay. Notice we debit cash and we eliminate the receivable. But essentially, if you combine those two, it's debit cash and it's a liability. We haven't earned the money yet. It's unearned revenue. Then in April, when we deliver the item, we get rid of the liability, which was in the first journal entry. We get rid of it with a debit. By debiting the liability, we're eliminating it. And now we move it from the liability category to the revenue category. Well, here's the second example. On January 1, Anderson entered into a contract with Tanner to sale of 2 excavators. And they're both going to be $350,000. So that's a total of $700,000. The contract requires 1 excavator to be delivered in February and states that the payment for the delivery of the first one is conditional on the delivery of the second one. So even though we've given it to them, they don't owe us the money yet. They will pay us when we deliver the second one in June. Notice, when we deliver the first one, we don't have a receivable, but we do have a contract asset, $350,000. We've delivered something, and we will eventually have the right to get paid. And we credit revenue. So we do show we've earned the money. We just don't have the right to collect it yet. Notice that the receivable has not been recognized. Then in June, when we deliver the second one, we're going to have, in this particular case, we're going to have a receivable of $700,000. That is the reversing of the contract asset of $350,000 plus the delivery of the second item. So that's a total of $700,000. And since we already recognized the revenue on the delivery of the first, we'll now recognize the revenue on the delivery of the second one. That's the way this would be done with a contract asset or a contract liability. Well, that takes advantage of I am a star, and hopefully this helps you understand how revenue recognition is recognized under Codification Topic 606.